Every year, millions of Americans sign the biggest financial commitment of their lives without truly understanding what they're agreeing to. Today, that changes. A mortgage is not just a loan, it is a legal pledge. When you sign one, you hand the bank the right to seize your home if you stop paying. That is the deal. And for most Americans, that deal lasts 30 years. Here is something almost no one teaches in school. In the early years of your mortgage, almost none of your payment touches your actual loan balance. Take a $300,000 mortgage at 7% interest. Your monthly payment is around $2,000. But in that very first payment, approximately $1,750 goes straight to the bank as interest. Only about $250 chips away at the $300,000 you actually borrowed. This is called amortization, and it is not an accident. It is by design. After 5 years of diligent payments on that loan, you will have sent the bank around $120,000. Yet your balance will have dropped by only $14,000. The bank has collected over $100,000, and you still owe nearly everything you started with. Understanding this is the first step toward using a mortgage on your terms instead of the bank's. Not all mortgages work the same way. Your two main options are fixed rate and adjustable rate mortgages, and the difference between them could determine whether you build wealth or lose your home. A fixed rate mortgage locks your interest rate for the entire life of the loan. If you sign at 6.5%, you pay 6.5%, whether the economy is booming or crashing, whether inflation spikes or falls. Your payment is completely predictable. You can plan around it. For most first-time buyers, this is the safer, more reliable choice. An adjustable rate mortgage, called an ARM, starts with a lower introductory rate, sometimes 1 to 2 percentage points below the fixed rate. That lower rate feels like a deal, but after a set period, usually 5 or 7 years, the rate adjusts based on current market conditions. It can go up significantly. During the 2008 financial crisis, millions of homeowners had adjustable rate mortgages. When those rates reset upward, monthly payments jumped by hundreds of dollars overnight. Many families simply could not absorb the shock. That is what triggered the wave of foreclosures that collapsed the housing market and reshaped the American economy for a decade. ARMs are not inherently dangerous, but they require a clear exit strategy. If you plan to sell or refinance before the adjustment kicks in, an ARM can genuinely save you money. If you are buying the home you intend to stay in for decades, a fixed rate protects you from a future you cannot predict. You do not just walk into a bank and receive whatever rate is posted on the wall. Your specific interest rate is calculated from your personal financial profile, and 3 factors matter more than anything else. First, your credit score. This single number carries more weight in mortgage pricing than almost any other factor. The difference between a credit score of 680 and a score of 760 might not sound dramatic, but on a $400,000 mortgage, that gap could mean paying more than $100,000 extra in interest over the life of your loan. Lenders see your score as a measure of risk. Higher score, lower risk, lower rate. Second, your down payment. When you put down less than 20% of the purchase price, lenders require you to purchase private mortgage insurance, known as PMI. This insurance protects the bank, not you, if you default. It typically costs between 0.5% and 1.5% of your loan amount each year. On a $300,000 loan, that is $1,500 to $4,500 per year, added directly to your housing cost. Reaching 20% equity and eliminating PMI is one of the highest return financial moves available to homeowners. Third, your debt-to-income ratio. This measures how much of your monthly income is already committed to debt payments, car loans, student loans, credit cards. Most lenders want this ratio below 43%. The lower it is, the more mortgage you qualify for, and often at better rates. These 3 levers, credit, down payment, and debt load, are the ones you control, and they are worth optimizing long before you ever set foot in a bank. Here's the part most homeowners miss. Signing your mortgage is not the end of the negotiation. It is just the beginning. Refinancing allows you to replace your existing mortgage with a new one, ideally at a lower interest rate, with better terms, or both. It is, in essence, a reset button for one of the largest debts you will ever carry. The classic rule of thumb says refinance only when the new rate is at least 1 percentage point lower than your current rate. That guidance still holds, but the complete picture depends on your break-even point. Refinancing costs money. Closing costs typically run between 2 and 5% of your loan balance. On a $300,000 loan, expect to pay $6,000 to $15,000 in fees. Your break-even point is simply how long until your monthly savings cover those upfront costs. Here's a real example. You refinance from 7.5% to 6%, cutting your monthly payment by $280. Your closing costs totaled $8,400. Divide $8,400 by 280 and you get 30 months, 2.5 years. If you stay in that home for longer than 30 months after the refinance closes, you come out ahead. If you sell sooner, the refinance cost you money. There is also cash-out refinancing, a tool that lets you borrow more than you currently owe and receive the difference as a lump sum. Homeowners use it for renovations, to consolidate higher interest debt, or to cover major expenses. The risk is real. You are resetting your loan clock, often extending it back to 30 years, and increasing the total interest you will pay over time. Used with discipline, it is powerful. Used carelessly, it is a trap. The key discipline: run the math every time, never refinance on impulse. Even with all of this knowledge, the mortgage process creates predictable pressure points where people make costly mistakes. Let us name them. Mistake 1: taking the first offer you receive. Mortgage shopping is legal, it is straightforward, and it can save you tens of thousands of dollars. Multiple credit inquiries for a mortgage within a 45-day window count as a single inquiry on your credit report. Use that window. Get quotes from at least 3 different lenders before choosing. Mistake 2: making a major purchase between approval and closing. After your mortgage is approved, but before you close, your lender conducts a final review of your financial picture. Buying a new car, opening a credit card, or making any large purchase can change your debt-to-income ratio enough to get your loan denied, sometimes just days before you're scheduled to receive your keys. Mistake 3: not reading the loan estimate. Federal law requires your lender to give you a standardized 3-page document called the loan estimate within 3 business days of your application. It details your rate, monthly payment, and all projected closing costs. Read every line carefully. This is where you find junk fees, administrative charges with vague descriptions, and terms that quietly differ from what you were quoted verbally. Understanding your mortgage is not just about saving money, though it will absolutely save you money. It is about having real leverage in one of the most consequential financial conversations of your life. The more you know going in, the better the terms you can negotiate coming out. If this gave you clarity, hit subscribe to the Loan Desk. Every week, we break down mortgages, refinancing, and real estate finance in plain language, so you can approach the biggest financial decisions of your life with confidence and control. Subscribe now, and we will see you in the next one.